Hello, everyone. Okay, as most of you already know, my name's Todd Mitchell, and I want to welcome all of you to the Winning Options Formula for Creating Consistent Income Workshop. All right, now I want to thank each and every one of you for taking your valuable time out of your busy schedules, right? I know we're all busy, so you could join us today. Really, really do appreciate that. Now I see tons and tons of familiar names from literally all over the world, and I do appreciate it. I'm just so glad you all could make it. I'm real excited, real excited. So now, with all the, I've gotten tons of calls this week, emails, because just from all the emails and calls, I know that the anticipation's high. It's really, really been quite extraordinary. So again, thank you for that, okay? We filled up real quickly for this workshop, and I was finally able to bump up capacity to 1,400 people, and we're just about there, okay? So I'm going to keep this intro real brief because Roger's got tons and tons of material to teach you today, okay? And again, before we start, I want to make sure that all of you can hear me. So if you can hear me, just please type in a quick note, yes, why, whatever you want to type, whatever, just to let me know that you can hear me all right. All right. Again, I want to absolutely make sure that there's no problem with the microphone. Okay. Yeah. All right. Literally hundreds of you are typing in that you can hear me just fine. Okay. Good. Good to know. Thank you. Thank you. All right. Now, again, we've got quite a long workshop for you today, a little longer than usual, but rest assured it's going to be full of actionable trading strategies and tactics that you can literally start using tomorrow if you really wanted to. So be sure to grab a pen, paper, and get ready to take some notes. And for those of you that are wondering, and I get this all the time, we get this all the time. Okay, I see a lot of you, right? Okay, a lot of you are typing in. Yes. You're going to be sent a recording. Yes, so the big question is, will this be recorded? And the answer is yes, emphatically, it will be recorded, and the PowerPoint presentation will be sent to you as well, okay? So again, we always get a bunch of people asking that. So be assured that this will be sent out to you probably within an hour after we finish here today, okay? And again, if you want to ask questions during the workshop, just type those in the box below and we'll be sure to answer those for you, okay? And now I know Roger will occasionally stop and answer some questions. That's great. I'm also going to be here, and me and my assistant will actually answer questions as well. We'll type them in, but again, Roger will in fact answer some questions as he's going. He likes to do that, breaks up some of the stuff he's doing, okay? So, all right, now that we've got all that out of the way, it's now time to pass the mic over to my good friend and trading associate, Roger, where he's got a fantastic, as usual, of course, and brand new presentation for you today. Then I'll be back to wrap it up and answer any remaining questions that you may still have, okay? Again, as you already know, Roger's an ex-hedge fund manager that took $20 million to $740 million, right? $750 million in just under 11 years, rather. So he's definitely worth listening to, all right? So without further ado, I'm going to go ahead and pass the mic over to my good friend Roger.
Thanks, Todd. I really appreciate that introduction, and I'm really happy to be with you and your valued group today, as usual. So thanks again. Before I begin, let me tell you a little bit about myself, for those of you who aren't familiar with who I am. As usual, I'll keep this very short, since I have so much to get through during today's class. I originally started trading in the early 90s, shortly before I applied to law school, and before I was accepted. I always joke that my timing was off by a little bit, because if I started trading just a few months earlier, I probably would have never decided to practice law. I did graduate from law school and earned my law degree, but I never practiced, and I knew that trading was my true calling in life, shortly after I placed my first trade. After I graduated, I started a brokerage firm, And a few years later, I started 2 hedge funds that over 10 years grew to slightly over $750 million. Unfortunately, running a large hedge fund requires much more regulatory work, and I had to deal with managing employees and filling out financial statements and doing things that I never wanted or never planned on doing. In addition, my family was growing, and I was spending over 16 hours daily at the office. So financially, I was doing very well, but my personal life started to suffer, and I decided to make a change before I was forced to make one. That was about a decade ago, and now I spend my time doing the 2 things that I love to do the most, and that's trading for myself and teaching traders like yourself how to trade more profitably. Before I begin, I need to go through the required disclaimer. This disclaimer makes lots of sense, so I will highlight the most important parts for you, and you can read the rest. The first thing that you need to know is that trading with real money involves a risk of loss, and if you use margin or leverage, you can lose more than what you originally started with. In other words, your risk will not be limited to your investment if you use margin or leverage in your trading. Keep that in mind. Second, don't trade with money that you've put away for a rainy day. And that's because trading involves psychological stress or pressure. And when you trade with funds that you saved up for a rainy day, you're putting additional pressure on yourself. And you may end up making the wrong decision. And lastly, you should paper trade or use very small position size when you're first starting out with a new strategy or just learning to trade. This way you can develop a feel or a propensity for the strategy that you intend to utilize and decrease the risk of making mistakes, such as putting in the wrong order and other avoidable mistakes that occur frequently. Okay, now that I've gone through the traditional housekeeping issues, we're ready to begin. So I'm going to start out by telling you exactly what I'm going to go over during today's options trading class. First, I'm going to introduce you to 2 spreads that I utilize for roughly 80% of all income strategies. This includes the credit spread and the iron condor spread. So I'm going to explain these spreads and give you the downside and the upside of each of these spreads. I'm also going to show you some examples so you can get a good feel for each of these 2 strategies. I'm then going to shift focus to the factors that influence these spreads. And one of the biggest factors that influences the value of options is actual and perceived volatility, which are factors that strongly influence the price or the value of the option. So I'm going to explain the 2 different ways to measure volatility, explain to you the importance of understanding volatility when it comes to both weekly and monthly options, and show you how to measure volatility. I've seen many traders try to explain this concept, and unfortunately, more often than not, it leads to confusion and frustration. So today I'm going to try and clarify this topic so that you have a crystal clear understanding before we conclude this class today. I'm also going to explain theta, or time decay, and explain the relationship between the option's volatility and how long the option has till expiration, because there's a relationship between these 2 factors. And lastly, I'm going to show you how I use actual price and technical indicators to determine the potential trading range for the underlying asset. We always want to take into account the underlying asset, and I'll show you how I use Bollinger Bands and support and resistance levels to gauge short-term and medium-term support and resistance levels. I use these methods to help me determine with high percentage of probability the support and resistance levels, especially for the types of spreads we plan on initiating. So today I'm going to demonstrate how I use these simple tools and provide you with some examples as well. As you can see, we have lots to get through today. But as I said a few minutes ago, by the time I'm done today, you should have a much better idea of the ingredients or the steps that you have to go through to successfully become an options income trader. And that actually leads me to where I wanted to begin, which is to explain what is options income trading and how is it different from directional options trading. And Karen from Vermont says this is going to be a terrific class. And Karen, I'm just getting started, but I promise you that you're going to get lots of real value out of this class. I'm only going to teach you actionable tactics that you can apply to the options market right away. So to begin, directional trading is trying to figure out the direction or the movement of the underlying asset. Very simply, if Microsoft is moving higher and you believe it's going to move higher, you either buy Microsoft stock or you buy a call option, which is the proper option to buy if you want to make money to the upside. In both of these cases, you're speculating that the underlying stock, which is Microsoft in this case, is going to move higher. Conversely, if you believe that the stock market is going to move lower, you would sell short the SPY ETF shares, for example, which are extremely liquid, or you can simply buy a put option, which would increase in value if the SPY ETF moved lower, since puts, contrary to call options, increase in value when the markets move lower or trade lower. So if you want to speculate on the direction of the stock or ETF or Forex or commodities, you're a directional trader. And if you believe that the underlying asset is moving higher, you would either buy the underlying asset or buy a call, which rises in value when the underlying asset moves higher. Or conversely, if you believe the underlying asset is going to move lower, you can either sell the underlying asset short, or you can buy a put when the underlying asset moves lower. So in a nutshell, that's an example of a directional trader. Now, I want to remind you, I'm going to go through very broad strokes at this point. And as I go deeper into the material that I'll cover today, I'll get a lot narrower in my focus. So please bear with me for the time being. An income trader, on the other hand, is much more concerned with not where the underlying asset is going to go next, but instead much more concerned with where the underlying asset is not going to go. So, for example, this is a chart of Apple stock. And you can see by looking at the chart that recently the stock tried twice to rally past the $112 level and failed. And hypothetically, you believe that the stock has peaked out and won't go above the 112 level for the next several months. And once again, I don't know whether or not Apple is going to go higher. I'm simply using it as an example to make a point. So there's a way for me to profit from Apple if the stock does not trade above the 112 level over the next 30 days. And I'll get into all the details of how I'm going to profit in just a bit. But for now, I just want you to understand the difference between directional and income trading. And that's where I'm going with this example. So whether Apple trades down to $50 per share or goes to $110 or stays at the current level wouldn't be of any concern to me. My only concern would be that Apple doesn't trade above the 112 level over the next 30 days. Or say, for example, or hypothetically, I believe that Apple won't trade above the 112 level. And in addition, during the next 30 days, I also believe that it won't trade below the 104 level. So let's say that I believe that Apple is going to stay within a trading range between the 112 level and the 104 price level. But I don't know specifically where it's going to go. Well, that's another example of income trading in comparison to directional trading. In one case, I have to be right on the direction of the underlying asset. And in the other scenario, I have to be right on where the underlying asset is not going to go, which is easier, and I'll explain why. First, and this only applies to stocks, These numbers are actually different for commodities and currencies. But since most of you are stock or ETF traders, you should know that stocks trend about 30% of the time. And the rest of the time they drift randomly, without much directional bias. The reason that's the case is because stocks have a limited amount of information that's available for traders to base their decisions on at any given time, in comparison to other markets like currencies, for example. So stocks tend to be range-bound or random much more than they trend. And you can see this by simply looking at a long-term chart of a stock or the S&P 500. And you will see that over time, most stocks trend roughly a third of the time. And we have a question from Todd, who's asking how these numbers work out for currencies. And I know others are asking the same question. So to answer your question, Todd, currencies are the best trending markets. And out of all the currencies, the best trending currency historically in all backtests is the Japanese yen. So I wouldn't apply what I'm teaching you, or in other words, I wouldn't apply income trading strategies to the Japanese yen, since it trends about 45% of the time. But I'll save that for another day. So because most stocks and ETFs are counter-trend markets, or markets that tend to produce many more false breakouts than actual breakouts, or trending cycles, traders who apply strategies that make money from range-bound markets instead of trending markets end up making money much more frequently, since there's much more opportunity. For example, let's say you're a speculative trader, and for that you need the stock market to trend. And most of you know that the US stock market can enter into a period or a cycle where it can stay near the same price level for an extended period of time, and then quickly move over a few days and then once again enter a prolonged trading range cycle that can persist for weeks and sometimes months on end. And if you take a look at the chart on the screen, you'll see a daily chart of the SPY, which is the ETF that follows the S&P 500. You can see how the entire market stays range-bound for roughly 6 months of the time. And since the average stock has a correlation to the overall market of about 65 to 70%, the trend or the trading action of the overall market can strongly influence the stocks that you're trading, especially if you're trading big cap stocks that have strong volume, because these stocks are going to be the same stocks that are accumulated and sold by large institutions who stick to highly liquid large cap stocks. So bigger stocks have even stronger correlation to the overall market. So getting back to my point, say you rely on trends or breakouts or momentum type of trading action, and you begin trading after the S&P 500 entered the type of trading range that you see in the current example. I can assure you that no matter how well you pick stocks that outperform the overall market, your success rate is going to be limited by the fact that the overall market is simply not trending. And this is going to spill over into the majority of stocks to some degree. And your percentage of losing trades will be higher. And even your winners will have smaller profits. So the point that I'm making is that the type of market that we're in can drastically impact your results if you're a directional trader. So you're dependent on the market to trend to a degree in order to profit from stocks or ETFs that you're trading. And obviously to a degree. There's always stocks and ETFs that trend and break out. But overall, you're dealing with an environment that's not favoring the directional trader. And because markets trend only about 30% of the time, you're limited to profiting only about 30% of the time. And that's the single biggest problem that directional traders and swing traders face. When the overall market is not trending strongly, our profits are smaller. and we have a higher percentage of losing trades. And unfortunately, there's nothing directional traders can do about it. Income traders, on the other hand, are always looking for stocks and ETFs that typically just finished going through a strong trending cycle and are pausing and losing direction. And I can assure you that if I was to go through 100 different stocks, we would end up with 70 to 80 that are doing very little, and only about 20 to 30 that are trending. So our opportunity to profit is increased substantially. And that's the first advantage of income trading. We're not limited by lack of market direction, which is the single biggest hurdle for directional traders. If you take a look at this chart of Microsoft, you can see that over a 1-year period of time, the stock had very little directional bias and only trended for about 2 to 3 months over the course of the year. And the rest of the time was range bound and wouldn't really offer too much upside to directional traders. The second advantage that income traders have over directional traders, and we'll get into this in much more detail in a bit, but income traders get paid at the time they initiate the trade, not after the trade is liquidated. So if you recall our example where we were convinced that Apple stock was going to stay below the 112 level over the next month, if we entered into that trade, for example, we would be paid up front. The downside is that whatever we get up front is the maximum that we can get. If Apple does in fact begin moving higher and does violate the $112 price level at any time before the 30 days are up, then we may have to give back the premium or the income that we received, and we may have to pay even more out of pocket. So there's an upside and a downside to income trading as well. But I can assure you that it's much easier to figure out where the stock is not going to go than where it is going to go. And because stocks only trend about a third of the time, it makes it easier to generate consistent income without having to determine market direction. And Marcus from North Carolina says that he finds it frustrating to have to pick market direction and hates being stopped out of losing trades. Marcus, thanks for participating. And some traders are just burned from having to pick direction or don't want to have to wait for trending periods and simply want to earn income on a more regular or consistent basis. And that's exactly what I'm going to jump into next. And thanks again for participating, Marcus. So now that I've explained the main difference between directional and income trading in a general sense, you should know that there are dozens of different types of income strategies that traders can utilize to take advantage of directionless market action. But I happen to prefer 2 specific strategies, and I've been using these strategies for roughly 20 years. And each time I try something creative or new or different, I end up coming back to my bread and butter strategies. And these are credit spreads and iron condor spreads. And that's what I'm going to talk about next. And we have a question from Alex who's asking if I trade butterflies and time spreads. And you should know, Alex, that oftentimes what looks good on paper doesn't always translate into profitable opportunities. And what ends up happening with some of these options strategies that look good on paper is the fact that they're too difficult to construct properly and simply end up not being worth the trouble. I find that when it comes to real-world trading, for the most part, iron condors and credit spreads work well and are very robust, as I'll explain in a minute. So I end up sticking with these 2 related strategies for roughly 80 to 90% of all income trades that I initiate. And I hope I was able to answer your question, Alex. Now, before I move on and go into the details of constructing these 2 spreads, I'd like to spend a few minutes talking about the difference between hedged and naked options. Because oftentimes traders who are just starting out think that selling options always involves naked or unhedged positions. And these types of positions have unlimited risk of loss and are very dangerous, and I would never recommend them. So when I talk about income trading, I'm not talking about selling naked options, and that's something you need to remember, because selling naked options is one of the most riskiest strategies and something I would never recommend to traders. So keep in mind, these are income spreads that I'm going to discuss, and they have limited risk of loss, and that risk is ascertained at the time the trade is initiated. So you know ahead of time what you'll earn from the trade and also what your maximum loss from the trade could end up being. And that's one of the best things about income trading when you're using hedged positions or positions that have limited risk of loss, is the ability to know ahead of time your maximum profit and exposure, because you'll have a better idea of your exposure in relationship to your risk, which is something that's very difficult to ascertain when you're trading directionally, because you never know whether the underlying asset is going to reach your profit target, or alternatively, stop you out before that price level is reached. And now I'm going to show you how to construct a simple credit spread, and a bit later how to construct the iron condor spread as well. A credit spread simply involves selling a call option with a lower strike price or exercise price, and buying a call option with a higher strike price at the same time. Or if we're planning on utilizing put options, we would sell the higher strike price option, the more expensive option, and buy the cheaper one, or the lower strike price option. It's really that simple. The profit potential when you initiate the credit spread is the difference between the expensive strike price option that you sold and the cheaper strike price option that you bought. And the maximum loss on the trade is the difference between the two strike prices minus the net premium that you received on the trade. If you're new to options, this may sound a bit complicated or overwhelming, but I'll go through a few examples to help you understand this from a practical perspective. Now, you may have noticed that I'm skipping some steps, such as what rights and obligations the options give you. And the reason why I'm skipping these steps is because I want to give you the big picture. And then if you have questions, we can fill in the blanks. But this way, you will at least have the structure or the skeleton. And that's what you really need to know at this point. So let's say that I believe that Home Depot stock has peaked out at the current price. And once again, this is just an example. The price at the present time is roughly $135 per share. And I believe, based on my analysis and my experience, that the price won't move above the 140 price level over the next month, hypothetically of course. So I go ahead and initiate a credit spread where I sell the 140 strike price call option for $1.12. And we take that premium in. That's a credit to our account. But we don't want to incur the unlimited risk that comes with it if Home Depot begins to move above the 140 strike price. We simply don't want to incur that risk or margin. So we go ahead and we buy the 142 call for 62 cents. And we initiate this spread either simultaneously or each option is bought and sold within a very close proximity to each other. So we just initiated a credit spread by selling a call option and at the same time buying a further out-of-the-money option to protect ourselves from unexpected price movement that can potentially occur if the stock rallies strongly over the next 3 weeks, which is when both options that make up the spread expire. We sold the 140 strike price call for $1.12, and we bought the 142 strike price call for 62 cents. So our net credit that we bring into the account is $1.12 minus the cost that we paid for the insurance or the protective option, which in this case is the 142 strike price call option. So our net premium for taking on this income trade is 50 cents. And our total risk is the difference between the two strike prices, minus the net premium, which is 50 cents. And that's what our broker is going to require us to have in our account before we initiate this trade. So our net premium for taking on this income trade is 50 cents. And our total risk is the difference between the two strike prices minus our net premium. And this is what our broker is going to require us to have in our account before we initiate this trade. This is our margin or our security. So let's walk through this step by step. We sold the 140 call and we bought the 142 call. So the difference between the two strike prices is $2. But we also took in a credit of 50 cents, which we subtract from the $2 or $200 because each option contract is 100 shares. So $2 equals $200 and 50 cents is actually $50. So our margin for this trade is $150. And that's what we will be required to keep in our account from the time we initiate the spread to the time we either offset it, which means liquidate it, or the time the spread expires, which is roughly 3 weeks after we first initiated it. If Home Depot stays at or below the $140 price level over the next 3 weeks, both options will expire worthless, and we will end up keeping the premium. But on the other hand, if the stock continues to rally and over the next 3 weeks moves from $135 to $175, for example, or even higher, our risk is always limited to the difference between the two strike prices, minus the net premium that we received, which in this case is $200 minus the $50 net premium. So our net risk, if the stock moves sharply higher in the worst case scenario, is always $150, and that's the worst case scenario. Now let's look at this trade from a slightly different perspective. $50 is 33% of $150. So we're actually getting paid 33% to hold the spread for 3 weeks. And 33% return on investment in 3 weeks is a very large return, as you can imagine. Now keep in mind, if we believe that $140 is too close, after all it's less than 5 points away from the current price of the stock, we can go to a higher strike price and we could incur less risk. But at the same time, we would receive less income from the trade. So there's always a trade-off between the income that you receive and the risk. And in just a bit, I'm going to show you how to increase the profit and decrease the potential risk on the trade. But for now, I just want you to understand the dynamics behind the credit spread, which is simply taking two options that expire at the same time and selling one that's more expensive than the other, and using the cheaper one as a hedge against the more expensive one, as protection against the underlying asset moving sharply against you. The example that I just showed you using Home Depot stock using calls is a simple credit spread. More specifically, it's called a bear call spread because we use calls and we profit if the underlying asset stays at the current price or trades lower. So it's not a bullish strategy even though we're using call options. I wanted to point that out to you. It's a bearish strategy that's constructed using call options, which most traders relate to buying when they believe the underlying asset is going to move higher. But in this case, we're doing the opposite. We're using a combination of calls, buying one and selling one. But we're not bullish, we're neutral or bearish instead. And we have a question from Michael, who's asking how to select the strike price for the short option. And that's a great question, Michael. And before we end the class today, I'm going to show you two different methods to help you select the short strike price and give you tips going forward. So we'll get to that in just a bit. And thanks again for participating, Michael. And we have another good question from Jason, who's asking if we usually use out-of-the-money options for credit spreads. And for those of you who are not familiar with the term out-of-the-money, it's simply referring to call options that have an exercise price or a strike price that's above the current price of the stock, or if we're trading put options, it would be a put option that's below the current price of the underlying asset, while at-the-money options would be options that have a strike price that's very close to the price of the underlying asset. And I just want to clarify this for traders who are just getting started and are trying to learn all the basics. And getting back to your question, Jason, since we want the options to expire and we don't want to take on too much directional risk, we typically use out-of-the-money options for our short strike price. And since our long option is always the cheaper one, then obviously they would also be further out of the money, whether we're trading puts or calls. When you initiate credit spreads that are at or very close to the money, you're taking on too much directional risk, which is one of the major factors we want to avoid when trading income strategies. So by selling options and buying options that are away from the current price, we substantially increase our odds of keeping the premium, which is our ultimate goal. And I hope I was able to answer your question, Jason, and thanks for participating today. So moving ahead, I'm going to show you a simple example of putting together a simple credit spread using put options. This spread is called a bull put spread because we're actually putting together a spread that has a bullish bias using put options. If you recall, the bear call spread was a bearish to neutral strategy that was constructed using calls. And in this case, we're constructing a put strategy, which is typically associated with bearish markets. But we're using puts to profit from the market staying at the current price level or moving higher. So it's a bullish to neutral put strategy, which is called a bull put credit spread. So let's go back to our Home Depot stock that we utilized for the bear call spread example. If you recall, the stock was trading near the $135 level. And we believe that not only is the stock not going to move above the $140 price level, but we also strongly believe that the stock is not going to trade below the $130 price level. So in a nutshell, we believe that Home Depot is going to stay range bound and within a 10-point trading range over the next 3 weeks. So we go ahead and sell the 130 strike price put option. But we also know from previous experience that no trade is guaranteed to work. So we go ahead and buy the 128 put just in case Home Depot begins trading lower and trades below the $130 price level. Both puts, the one we bought and sold, expire on the same day as the call spread that we initiated and discussed just a few minutes ago. So let me give you a bit more detail about the put that we sold and the put that we bought. The 130 strike price put that we sold, we were able to sell for $1.18. And the 128 strike price put, the one that we purchased for 85 cents. So the total credit on the trade is 33 cents, while the risk on the trade is the difference between the two strike prices minus the net premium that we received. The difference between the two strike prices is $2. And if we subtract the premium of 33 cents, we end up with $1.67, which would be our margin on the trade. Keep in mind that each contract is 100 shares. So we're talking about taking in $33 per contract, and our maximum loss would be $167 per contract. $33 is slightly less than 20%, or roughly 19.7%, which is the return that you would make for holding this position for roughly 3 weeks. Now, I don't know about you, but 20% return on investment in 3 weeks is not that bad. But it gets much better than that. If you recall, I promised you in the beginning of this class that I was going to explain not only the credit spread, but also the iron condor spread. And up till now, I showed you 2 separate credit spreads. The bear call spread by selling and buying the call option, the 140 and the 142 strike price, and similarly initiating a bull put spread by selling the 130 strike price put option and buying the 128 strike price put option. What I just demonstrated was actually an iron condor spread. I didn't tell you that's what I was planning ahead of time, but when you initiate a bear call spread and a bull put spread with all options expiring on the same day and using the same underlying asset, you're effectively initiating an iron condor spread, which is just another name for 2 credit spreads on the same asset with the same expiration date. So now let's review the 2 spreads, the bear call spread and the bull put spread, as one strategy. And the next step is to show you the advantage of this one strategy, the iron condor spread, in comparison to initiating just one side of the spread or just one credit spread instead of both sides. You should also know that when you're initiating the iron condor spread or 2 credit spreads on the same underlying asset with the same expiration date, which is what we're doing with the Home Depot options, we would refer to each credit spread as each wing of the iron condor spread, since both credit spreads make up both wings. I want to show you the advantage of initiating the iron condor spread over initiating just one side, one wing or one credit spread, instead of both sides. In 3 weeks, when both credit spreads, the bull put spread and the bear call spread expire, the price of Home Depot cannot be at 2 different prices at the same time. That's an impossibility. And this is very important to understand because it gives us a major advantage that we don't get when we're trading credit spreads individually. Let's forget about the options that we bought for a minute. Let's just focus on the options that we sold. If you recall, we sold the 130 strike price put and we sold the 140 strike price call. And there's no way that it's mathematically possible for Home Depot stock to end up on expiration below 130 and above 140. That's just an impossibility. And because that's an impossibility, the margin or the security deposit for the iron condor spread is substantially lower than when you initiate credit spreads individually that don't have the same expiration date or use the same underlying asset. Because when you have different expiration dates, then it's obviously possible for the stock to be at 2 different prices on 2 separate dates. And it's obviously possible for 2 different stocks to be at 2 different prices at the same time on the same date. But it's not possible for the same stock to end up at 2 different prices at the same time and date. So that's why the margin or the security deposit for the iron condor spread is the largest of the 2 legs or the largest of the 2 credit spreads that you initiated, assuming that one is larger than the other. So let me put some real numbers behind this for you. It'll be much easier to understand it that way. If you recall, in the Home Depot example that we just went through, the security deposit or margin for the bear call spread was $150, and the security deposit or the margin for the bull put spread was $167, if you recall. So the bull put spread had a larger margin, and that's going to be the security deposit that the broker will use for the entire spread, all 4 sides or 4 wings or both credit spreads. however you want to refer to that trade. So now let's look at the Iron Condor spread that we initiated, knowing what we know, and see the type of difference that it makes. Because using only one side of margin completely changes the dynamics of the trade. So here's how it all shakes out. We brought in a credit of 50 cents from the bear call spread, and we brought in 37 cents from the bull put side, or wing of the spread. So we brought in a total of 87 cents. The maximum loss on the trade as a whole has changed as well. Since we brought in two premiums, but the underlying asset can still only end up at one price at expiration. So our risk, regardless of whether the stock rallies very strongly or drops like a rock, is limited to $2, which is the difference between the 140 call and the 142 call, or the 130 put and the 128 put, minus the net credit that we brought in, which is 87 cents. So our maximum loss is $2 minus 87 cents, which is $1.13. And our maximum profit is 87 cents, or $87 per contract. But as long as Home Depot stays between $130 and $140 over the next 3 weeks, we get to keep that premium. So in essence, we're risking $113 to make $87, which is a 76% return on investment, and is not a bad return for 3 weeks of work. And we have a question from Peter, who's asking what our break-even price level is on each side of the Iron Condor spread. And that's an easy one, Peter. As I mentioned, the maximum profit level is between $130 and $140, which is a fairly wide profit zone. But the break-even profit zone is simply $140 plus the premium that we received, which is 87 cents. So the maximum upside break-even level is $140.87, and the maximum downside break-even level is $130 minus 87 cents. So the downside break-even level is $129.13, and these two levels are our break-even levels, one to the upside and one to the downside. So in a nutshell, what I just demonstrated was a bear call spread by selling a call above the current price of the underlying asset, and then buying a call slightly higher. And unless the underlying asset moves higher, you would get to keep the net premium received, or the difference between the two strike prices of the two calls, the one you bought and the one that you sold. I also explained the bull put spread, which we initiated by selling a put below the price of the underlying asset, and at the same time bought a cheaper put with the same expiration date, and you kept the difference between the two, the net premium. I then expanded on this concept by explaining that as long as both the call credit spread and the put credit spread both expire on the same date and are based on the same underlying asset, the spread ends up being an Iron Condor spread. And because the underlying asset cannot end up at expiration at two different prices at the same time, the margin or security deposit for both credit spreads is the largest of the two sides, assuming they're both different from each other. But beneficial to us, we still get to take in both sides of the premium. So we get two premiums, but we're only charged one margin when we initiate the Iron Condor spread, instead of just one leg or just credit spreads individually, which is a major benefit of Iron Condor spreads. Aside from profiting from range-bound markets, which happen to dominate the stock market about 2/3 of the time. Finally, the maximum profit potential is the distance between the two short strike prices, which in our Home Depot example was the distance between the 130 and the 140 strike price. The maximum break-even, on the other hand, is the upper short strike price call, the 140 strike price, plus the net premium received, which in our case was 87 cents or $87. And on the downside, it's the lower short strike price put, which in this case is the 130 strike price put option, minus the net premium received, which is once again 87 cents. So our downside maximum break even is $129.13. And once again, our upside break even is $140.87. Now, before I move on, what I just demonstrated, the basic principles of putting together a simple credit spread or an iron condor spread, it's not a very difficult process. And just about anyone can put one together, just like I demonstrated over the past half hour. But as they often say, the devil is in the details. And when it comes to options income trading, nothing could be more truthful. Options have several factors that we have to take into account. These factors can substantially increase the net premium that we receive, lower the risk or margin on the trade, and at the same time increase our chance of keeping that premium. And that's what you really need to know. And that's what separates professional options traders from beginners who believe they can just pick their favorite stocks and begin trading credit spreads and iron condor spreads. While I'm not trying to discourage you, I do want you to know that because options are derivatives, unlike the underlying asset, there are factors that can dramatically influence the price of the option, even when the underlying asset's price is doing very little. So by taking these factors into account, we can accurately assess each spread from a risk to reward perspective and construct each trade with the highest probability of profiting, instead of just trading based on how you feel or your emotions, which is not the best way to approach option trading, especially option income trading over time. You have to keep in mind that you're competing against professional traders who are taking all factors into account. So if you want to compete with the big boys, you have to look at options from the same perspective as they do. So I highly encourage you to pay attention to the factors that I'm going to discuss, because they can make a major difference in the amount of premium that you receive for the amount of risk that you incur. So keep that in mind as I go through the next section. And Tony from Hawaii says this is the best taught class that he's ever attended. And I'd like to thank you for the nice words, Tony. So the first factor that I'd like to talk about, and one that influences the value of the option more than anything else, is the actual value of the underlying asset and the anticipated or the perceived volatility of the asset in the future, which are two factors that have a major influence on the option's value. And once again, I'm going to skip the details and focus on the big picture. Otherwise, this course is going to turn into a 3-hour workshop. And then I risk putting some of you to sleep, which is not a chance that I want to take. Okay, so let's take a stock, for example. Let's take IBM, since most of you are familiar with that stock. The price of the stock from a few days ago was roughly $150 per share. And based on a cursory look at the stock's daily price fluctuation, it typically fluctuates about $3.50 per day on average over time, at least over the past month or so. Now, $3.50 is roughly 2.3% of $150. So you can say that over the past 30 days or so, the historic volatility of IBM is 2.3%. We figured out the historic volatility by taking the daily trading range and dividing it by the price of the stock, which is very simple. Now, you may be thinking to yourself, what does all this have to do with options? Well, options are derivatives. And typically, assuming there's nothing new or interesting, that's going on with a stock, the level of volatility that's priced into the option will be very close to the historic volatility level of the underlying stock, which makes perfect sense, since the stock is expected in the future to continue to trade within the same trading range that we've seen in the past. If you see a stock with a typical trading range of $5, then you would expect that trading range to continue, which once again is completely normal and expected. Now, let's say that IBM is expecting earnings, and over the past several quarters, the stock's been moving substantially higher each time earnings come out, and the stock jumps 10% in value each time earnings have come out over the past 5 quarters, hypothetically, of course. Well, options traders have memories like elephants, and unless something changes or there's some type of an announcement from IBM before earnings are coming out, traders will once again think that the stock is going to jump up 10% when earnings come out, since it happened 5 quarters in the past. Hypothetically, once again. So if you recall, the average trading range of IBM is 2.3% or $3.50. But traders are all of a sudden expecting the trading range of IBM to fluctuate $10 instead of $3.50. And if you recall, I mentioned that options are derivatives of the underlying asset and take into account the anticipated change in volatility or anything else that's anticipated to change in regards to the underlying asset. So in this case, the factors that influence the price of the option the most, which is the actual and perceived volatility of the underlying asset, is going to drastically change as IBM gets closer to earnings date. You will see the price of the option drastically increase by as much as 200 or even 300%. Because, as I mentioned previously, the options are pricing in the fact that IBM is going to start jumping around $10, while historically, IBM jumps around only $3.50. So the expectation is that IBM is going to fluctuate over 3 times as much as it does on a regular basis. So I can assure you that options are going to increase in price dramatically. Now, what I just described to you, without putting labels on it, is implied volatility and historic volatility. And when I begin explaining it academically, it usually causes a few students to fall asleep. But in this case, I wanted to first expose you to it with a practical example. And now that you understand the underlying issue and what happens, I'll get a bit more technical about both implied and historic volatility to give you a very good understanding, and more importantly, an appreciation for the influence that it can have on the price of the option. So let's start with historic volatility. If you recall, we were able to identify the historic volatility level by simply looking at the recent history of the daily trading range of the stock and dividing it by the value of the stock, which is super simple to do. And we realized that the daily trading range, or the historic volatility, which is the same thing, is 2.3%. So if you hear all this talk about historic volatility, all you have to know is that it's simply the daily fluctuation of the underlying asset. And it's typically the volatility level that's priced into the option as well. Now, let's get to the good stuff. As I mentioned earlier, as we get closer to earnings, option traders remembered that IBM rallied $10 the last time earnings came out. Once again, hypothetically. So this $10 volatility will become slowly priced into the value of the option, which, as you can imagine, will cause the option to drastically increase in price. But here's what you need to know. We were able to ascertain the historic volatility level by simply looking at IBM and comparing it to its daily price fluctuation. But with earnings coming out in a few days, the option is rising in price. but the underlying asset, or IBM in this case, is staying at the same price. This is happening because traders are expecting a major price fluctuation, much more than the daily price fluctuation that IBM is accustomed to, over 4 times as large to be exact. So the question becomes, how do we know or figure out what the option market is pricing the volatility of the option in comparison to its historic value? And the way we do this is by taking the at-the-money option, which is the option that has the same strike price as the price of the underlying asset or close to it, and putting it into a pricing model. And that will tell us the volatility that's currently being priced into the option. Unfortunately, unlike historic volatility, you cannot determine the actual volatility of the option by looking at anything other than the option. And by looking at the actual option price, we can see what the market is implying the value of that option to be worth at the market. So we take a pricing model, and you can think of it as a microscope, and we put the option under the microscope, and it tells us that the market is currently pricing this option at 10% volatility, while the historic volatility is 2.3%, as we have learned from looking at the stock's past trading range. Now that I've explained the difference between historic and implied volatility, let me explain to you why it's so important. Stock's volatility fluctuates, and then it reverts back to normal daily range, while options volatility works much the same way. As I explained before, the stock's volatility, or the perceived change in the price of the stock, can make a huge difference in the price of the option. For example, when the at-the-money IBM option is trading outside of earnings season, it prices volatility at 2 to 3%, which tells us that option traders are anticipating the daily trading range of IBM to be at about 2 to 3% per day, based on its current price. And as soon as we get closer to earnings, the price of the option is going to reflect a change in the price of $10 per day. And to give you some perspective, that change in perception, whether or not it really happens, can potentially cause the option to triple in value. So an option that was valued by the market at $2 may end up costing $6, while the market's perspective or perception is that IBM is going to start fluctuating $10 per day instead of $2 to $3 per day. Now, here's the fun part. If you look at any liquid tradable asset, whether it's a stock or a commodity or just about anything tradable, you will see by looking at the technical chart that the asset increases in volatility, and then typically over a short period of time, the volatility level reverts back to its average or usual volatility level. I'm sure you've seen stocks that move $2 per day, and then there's some type of an announcement or earnings or something else that could potentially have an impact on the price of the stock. And the stock's daily range drastically changes. And then over time, as the news becomes priced into the asset, the trading range slowly reverts back to its usual typical or historic daily range, just like the example that you currently see on the screen. This is Time Warner Cable, everyone's favorite cable company. And you can see that over the course of 1 year, the stock went through 4 distinct periods where it had excessive volatility. And then very quickly, typically within a few days, the stock went back to its usual or typical trading range. And that's really what I'm talking about. And the same thing happens with options, just as I mentioned a few minutes ago. If we look at an option right now on a random stock that hasn't done much in a few weeks and isn't expected to do much over the next few weeks, and assuming the trading range is fairly consistent, I can assure you that if we were to check the implied volatility by taking the at-the-money option and putting it through a pricing model, the implied volatility level would be very close in line with the historic volatility level. So if the stock fluctuates $2 per day on average, the historic volatility would be 2%, and the implied volatility of the option, based on the price as seen through the pricing model, will also be 2% or close to it. But let's say that the president of the company has an announcement and says that in the next 6 weeks there's a good chance that we're going to be bought out by a much larger company, which would overnight substantially increase the price of the stock and thereby the option. Well, the price of the option would begin increasing even if the price of the stock doesn't move 1 cent just yet. So the option's price would begin increasing and increasing due to the change in the perceived volatility of the underlying asset, or the implied volatility of the option, which is one and the same. So take a look at this chart. It's a chart of IBM stock. This chart shows you the price of the stock, the implied volatility as measured by the at-the-money options, and historic volatility as well. And here's what I wanted to get across. Just like stocks fluctuate strongly and revert back to their normal trading range, the option's implied volatility similarly moves substantially above its historic volatility level, and over time reverts back to its historic volatility level. You can think of historic volatility as the average daily fluctuation in the stock price, and implied volatility as the sudden spike in the daily fluctuation in the price of the stock. Almost always, the exaggerated volatility will revert back to normal, and that's what happens with implied volatility over time. Usually a few days after the event that caused the spike in volatility, the levels will revert back to historic volatility, or will begin to do so gradually. The point that I want you to take from this is that you can always figure out the fair value of the option by utilizing its historic volatility level, which is the typical volatility level that's priced into the option. You can also see the difference in the price of the option between the current price and the price when volatility is low, because you can determine the difference in volatility by comparing the current implied volatility with historic volatility. Just like you can take the average volatility of the stock and compare it to the current trading range, and you can easily see the difference and determine if it's big enough to justify taking the trade. And before moving forward, I wanted to make a quick comment about this chart. If you recall, when I was demonstrating how to figure out historic volatility, which I did by hand by looking at the price of the stock, was 2.3%. And by looking at this chart, you can see that I was right on the dot, or just a dime or so below the actual level, which is right around the 0.24 level, which is actually 2.4%, instead of my crude estimate of 2.3%. But you can see I was able to come within 10 cents of the actual historic volatility level just by visually looking at the chart. Also, you can see how every time volatility spikes, it tends to revert back to historic levels over a very short period of time. So how can this information help us in a practical sense? You may be wondering. Well, if you're looking at an option and you're thinking of initiating a credit spread or an iron condor spread, and you look at the historic volatility and it's 2%, and then you look at the at-the-money option and the implied volatility is roughly 2% as well, that tells you that the option is rather fairly priced, and selling this option is not a great idea. Because if there's some type of news coming out or anything else, the volatility level will spike and the option will begin increasing in value, which is not what you want when you're thinking of making money by bringing in premium. You want the option to be expensive before you initiate the spread, not after. So this is something you want to know. In actuality, you want to initiate the spread when implied volatility based on the price or as reflected by the price of the option is expensive in relationship to its historic volatility. So you want the option's implied volatility to be 10% and the historic volatility to be at 2%, for example. Then you know you're selling an option that's more expensive in relationship to its historic value. And we have a question from Jackson who's asking if we can determine the implied volatility of each option separately or just use the at-the-money option. Jackson, that's a great question. You can determine the implied volatility of each option by putting it through the option pricing model, but typically, to some degree, all options in the chain, as long as they have the same expiration, will be impacted. So most traders stick with the at-the-money option since they give the most accurate representation of the underlying asset. And if your broker has options analytics, which most option brokers do at this point in time, that typically uses the at-the-money option to determine implied volatility. With historic volatility, it's not really an issue. You just need the price of the stock and the average daily range to get that data, as you've seen by the examples that I've demonstrated. And I know I moved very quickly through some parts, but I wanted to give you the big picture because when you're trading credit spreads and iron condor spreads, you're relying on the income that you get from the options up front, and nothing impacts or influences the price of the options more than the perceived change in the price of the underlying asset, which is priced and reflected in the options price at all times, and is what we call the implied volatility of that option. I just want to make sure that we're clear on that. I've seen instances where the price of the stock is holding steady and the option doubles in price. And I want to make sure you initiate credit spreads and iron condor spreads after that happens, not before. So always consider the implied volatility and the historic volatility in your options analysis, regardless if you're buying or selling. But it's especially important if you're selling because your premium that you receive cannot increase beyond the initial premium that you receive. But when you're buying options, your profit is theoretically unlimited. So when you're bringing in premium and your income is limited to that premium, you have to be extra careful. Okay, so I'm going to move on to theta, which is a Greek term that refers to rate or measurement of time decay, which is very important to option spread sellers because our job is to get as much premium as possible. And we do that by making sure the implied volatility of the option is as high as possible. But we also have to focus on the rate of decay of the option, since options are decaying assets and decrease in value over time. So I wanted to go over some important considerations as they relate to the rate of decay of the option, which is another major factor if you trade credit spreads or iron condor spreads. In recent years, weekly options have become extremely popular because they're around for about a week and then they expire. And I've seen, especially over the past few years, dozens of weekly option income programs pop up, which makes sense since weekly options are still growing in popularity. But here's the thing that you need to understand, and this ties in volatility with time value and how it all relates to weekly and monthly options. As I explained just a few minutes ago, volatility, or the degree of volatility that the option is implying based on its price, is based on perception of the change in the price of the underlying asset, or in simple terms, uncertainty or speculation as to the change in price at some point in the future. And the more time we go into the future, the more uncertainty we have in relationship to everything in life, not just what the stock we're looking at is going to do. In other words, we can probably predict with much more certainty what ABC stock will do over the next few days than what it will do over the next 2 months. That's just simple common sense. So the more time exists between the present time and the option's expiration, the more uncertainty will attach to that option. And naturally, the option with more uncertainty will have higher implied volatility level than the option that's based on a high degree of certainty. If you don't believe what I'm saying, just look at the at-the-money price of a blue chip stocks option and look at a tech stocks at-the-money option. I can assure you the tech stock will be more expensive, and that's because it has more volatility, and volatility equals more uncertainty. So when we're dealing with weekly options, there are very limited times when volatility increases to a point where selling them becomes worthwhile. For example, before a major Fed announcement or possibly during earnings season. But for the most part, the premium that you receive from a weekly option will not have enough theta, which is time premium, or volatility in its price or volatility in its premium to make the sale worthwhile. And what you end up doing is putting yourself at risk, which you do anyway. But the difference is you put yourself at risk and at the same time, you're not taking in enough premium to justify that risk. It's just that simple. Imagine you're an insurance company and you have to pay out every time there's a claim. Well, imagine every time someone breaks an arm, you have to pay 10 times the amount that you normally do. That's the problem you face with weekly options majority of the time, simply because there's not enough theta or time value to justify the sale of these options, unless implied volatility is very high. And it just doesn't happen as often as you may think. Take a look at the chart of VIX index. This tracks the implied volatility of the S&P 500 at-the-money options. If you were to put the S&P at-the-money options into a pricing model, this chart is what you would end up with, in a nutshell. Since the S&P 500 is so popular, the exchange decided to create an instrument that continuously measures the short-term anticipated or implied volatility of traders who buy and sell S&P 500 options. So you can see at any given time by going to your quote machine, and sometimes you have to put a dollar sign, but the ticker is VIX. And if it's below 20, that means that implied volatility is low on the S&P 500 or stocks in the S&P 500. And selling weekly options is not a good idea. You want to sell weekly options when volatility is spiking like crazy. And if it's not, then you want to stay away from the S&P 500 or stocks in the S&P 500. And we have a comment from Todd who says that he wishes he knew this information before he signed up for a weekly S&P 500 option selling service. Todd, selling weekly credit spreads on the SPY or the S&P 500 is a great idea. But you have to do it when volatility is high. It's not something you can just do blindly each week to earn an income. You can do it, of course, but you're assuming too much risk for the income that you're bringing in. But what you can do when implied volatility is low is avoid weekly options and initiate credit spreads or iron condor spreads that are a few months out. In other words, they don't expire for a few months and have high implied volatility. And you sell credit spreads using these options, and you hold these spreads for a few weeks and then you buy them back. So you're still earning income, but you're doing it in a much safer way. And you're still holding the position for a limited time, sometimes maybe longer than 1 week. You may end up holding the position for 2 weeks or 9 days, but your risk is much lower and the premium that you receive is much higher. So it's a substantially higher profit to risk ratio. And that's what you do when weekly options don't offer the kind of return because volatility levels are low. And when they rise again, then you switch to weekly options. And I'll talk more about this topic before we conclude today. And thanks again for participating, Todd. I do appreciate it. So always consider theta or time value. And remember that utilizing weekly options for credit spreads and iron condor spreads when implied volatility is high and the income you make justifies the risk. Unfortunately, that's not the case all the time. And when implied volatility level is low, The better strategy and a safer strategy is to initiate credit spreads and iron condor spreads utilizing options that have a few months left before expiration, and liquidate the spread after it decreased in value over a period of a few weeks. And obviously there's more to it than just finding options that expire in a few months. There's technical factors that I'm about to explain, and delta, and several other factors. So keep in mind, I'm trying to give you the big picture. Okay, so let's move on to the technical factors that I promised I would go over. And I'm going to explain two different technical methods. These are methods that I use to determine the short strike price of the option that makes up the credit spread, or one side of the iron condor spread. Because we measure these levels for the bear call spread and the bull put spread individually or separately. The first indicator that I utilize to determine the resistance or the support level for the short strike prices are Bollinger Bands. And I utilize the bands mostly when I'm searching for weekly options or monthly options that have less than 10 days till expiration. There's no difference between monthly options with a short time period till expiration and weekly options. So what we're really talking about are positions that I'm planning on holding for less than 10 days. If I'm planning on holding iron condor spreads or credit spreads for a longer period of time, then I may apply a different indicator. But for short-term time frame, I prefer Bollinger Bands. The Bollinger Band is a very simple band, plotted 2 standard deviations away from a 20-day simple moving average indicator. Because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to market conditions. When markets become more volatile, the bands widen or move further away from the average. And during less volatile periods, the bands contract and move closer to the average. The closer the price moves to the upper band, the more it indicates that the market is overbought. And the closer the price moves to the lower band, it indicates that the market is oversold. As you can see by the chart of Alphabet or Google stock with the Bollinger Band indicator, you can see how the Bollinger Band acts like an envelope, which keeps the majority of price action between the upper and the lower band. Obviously, there will be times when price breaches the bands, but out of the box with a 20-day simple moving average and 2 standard deviations, they make a great indicator to help you determine the upper resistance and the lower support level over the next several days, which is ultimately the key when you're planning on holding the spread for less than 2 weeks. If on the other hand I'm looking at longer term options, those that I'm going to hold for longer than a few weeks, where I'm going out a few months and looking to offset the option instead of letting it expire, like we would with weekly options, then I would instead look at something a bit broader, such as the 6-month high and 6-month low. If you look at this example, which is the same chart that we used for the Bollinger Band example, and I purposely left the Bollinger Band on so you can see the difference between the 2 levels. As you can see, the Bollinger Bands are a bit more conservative. Not too much, but the bands are typically narrower. And once again, I'm going through the broad strokes. And I also consider several other factors in my analysis. But technically, if you're looking at options that you're holding for a very short time till expiration, then you want to focus more on the Bollinger Bands. And if you're focused more on time value and a bit more time premium, and that means more premium, then I recommend you use more conservative price levels. And 6-month highs and lows have worked well for me over the years. There's one other very important indicator that I utilize to help me decide which option to buy and sell, and that's the options delta. But I'll save that for another workshop. And George from New York says that he's tried to understand volatility for 5 years and didn't get it till now. I'm glad I was able to help you out, George, and thank you for participating. We also have a question from Paul who's asking if we offer an advisory or alert service where I identify the type of credit spreads and iron condor spreads And Paul, your question is right on target. Because today we have an announcement to make. And I want you to know that I'm announcing it here for the first time. And you're the first ones getting the news. But over the past year, Todd and I have been getting requests for a service specifically related to options trading. And we've been quietly working behind the scenes. And today we're launching this advisory service specifically designed and created for options traders like yourself. First, I'm going to tell you about our new options advisory program, which is called Options Income Formula. And it's actually 6 advisory services in one. So let me explain. First, we cover both credit spreads and iron condor spreads. And we cover both stocks and ETFs. So you don't have to subscribe to 2 separate services to get advisory on stocks and index options, and 2 other separate services for credit spreads and iron condor spreads. We cover them all in one program. This means when stocks or indexes are moving directionally, we focus on credit spreads. And when there's little directional bias, we then focus on iron condor spreads. Similarly, when implied volatility level is high and most options are overpriced, we target credit spreads and iron condor spreads that expire within a week or 10 days. And if implied volatility level is lower, we don't just give you weekly alerts. That doesn't make sense. We then step back and look at credit spreads and iron condor spreads that expire in a month or 2. And we handpick the best spreads that offer the highest premium and the highest degree of time decay within the shortest period of time. And we don't hold these spreads till expiration. We liquidate them instead after they decrease enough in value. And if we have to hold them for 2 weeks instead of 7 or 5 days, it's worth it because it's safer and offers better return on capital. So we focus on weekly and monthly options, in addition to focusing on credit spreads and iron condor spreads. Now, if implied volatility in the VIX is low, I'm not going to recommend you initiate a credit spread on the SPY or S&P 500 options, just because it's time to give you a recommendation. That doesn't make sense. So when implied volatility is high on the SPY, we focus on credit spreads and iron condor spreads in the main indexes. And when implied volatility is moving lower, we then focus on individual stocks that are experiencing volatility spikes. So in summary, as a member of the Options Income Formula, you get advisory alerts on both weekly options and monthly options, both equity and index or ETF options. And we include both credit spreads and iron condor spreads. So you don't have to join 6 different programs. Options Income Formula truly gives you everything you need to succeed without you having to spend massive amount of money on 6 different programs. And Gene from New Jersey says, I've been waiting for an options advisory program from you for over 2 years now. This is going to be great. Gene, we wanted to do a test program with a dozen or so traders who have been in our swing trading program for a few years and make sure we got everything just right before launching the Options Income Formula. And let me give you some more info about the program and some more details. The Options Income Formula is a complete advisory alert program where we notify you via email if there's a new trade with all the details. But I'm getting ahead of myself. First, each spread is screened for delta, which is another Greek just like theta, and delta gives us the odds of the option expiring in the money or worthless. We also screen for implied and historic volatility, just like I demonstrated in today's class. We also check for any other major announcement that can impact or distort the price of the option or the spread. So if there's takeover news or upcoming earnings, we'll make sure to screen for that. I also apply several technical and momentum indicators that have consistently outperformed the market over the past 20 years, which is something most option income traders do not do, unfortunately. When you add technical and momentum analysis to options income spreads, you add an entire dimension which really helps you confirm that your short strike price conforms to not just statistical or mathematical numbers, but also conforms to technical price levels. And when I select a spread, I always give you my technical view of the underlying asset, so that you can see the stock or the ETF from the same perspective that I do. I'd like to go over a few recent trades so you can get a good understanding of both the credit spreads and the iron condor spreads that I'm trading in the Options Income Formula Advisory Program. This is a LinkedIn credit spread from February of this year. The price of the stock was roughly at $103.97 at the time that we placed the trade, or initiated this credit spread. The credit spread consisted of selling the 95 strike price put option and buying the 92 strike price put. We initiated or opened the spread on the 12th and closed the spread out on the 18th. So we didn't hold it for a very long time, as you can see. We brought in on the spread a net premium of $1.18 or $118 per contract. And we liquidated the spread for 17 cents or $17 per contract. So the net premium that we kept was $101 per contract for 4 days of work. The net return on margin is the difference between the two strike prices minus the net premium that we received, and that was 25.31%, which is truly amazing for 4 days of work. But in actuality, our risk per trade was substantially smaller than that, and I'll go over that after I finish going over the examples. So our profit, or our return based on our actual risk, was higher than 25.31%. But if you look at it from a pure mathematical perspective, then it's a 25.31%. And I'll go over this in just a few minutes after I wrap up this part. So in a nutshell, this wasn't an iron condor spread, but only one wing of the iron condor, or a simple credit spread. The next trade was Gild Science, a large cap stock with fairly liquid options. And let me walk you through this trade step by step. The spread was held for a total of 8 trading sessions, and it was liquidated. So it's a good example of income strategies that are not based on weekly options, but instead ordinary monthly options, but holding the trade for a limited amount of time. And instead of relying on the spread to expire, you liquidate the spread instead. So getting back to the actual trade. We entered the trade when Gild was at $89.40, and we exited the trade when the stock was at $88.40. So it was fairly flat when we initiated the iron condor spread. We sold the March 105 call and bought the March 100 call, and we sold the March 80 put and bought the March 75 put. All options were to expire on March 18th. But were liquidated instead of waiting till expiration. If I wanted to wait a bit more, I could have made about double what I made on this trade, but the trade-off would be holding it for a longer period of time. But I was very happy with 12% profit after holding the trade for only 8 trading sessions, which is more than the S&P 500 makes on an average year. Once again, the profit that I'm giving you is based on the security deposit that your broker would use to secure the iron condor spread, which is taking the side with the biggest spread and subtracting the net premium that you receive from both credit spreads. In this case, the spread between the strike prices of the options that were bought and sold were the same on both the call side and the put side, so it didn't really make a difference. And my actual profit based on my risk was larger than 12%. And I'll explain that as well after I go through one more example. But my profit based on margin or security deposit was slightly over 12%. This is one stock that most of us are very familiar with, McDonald's. And we held this iron condor spread for a total of 12 trading sessions. and closed it out with a profit instead of letting it expire. And don't forget, when we liquidate the spread, we send you an email letting you know exactly what we're doing. So there's no surprises. You always know exactly what we're doing. But getting back to my McDonald's example, we initiated the spread when the stock was at about $117 and liquidated the spread when the stock was at about $115. And we initiated the bear call spread by selling the 125 call and buying the 130 call. And we initiated the bull put spread by selling the 105 put and buying the 100 put. And these options were to expire in March, but we liquidated them in February, long before expiration. We made about 18% return on margin, and we made substantially more based on risk. So once again, 18% return without market timing for holding the position for 12 trading sessions. And in my opinion, 18% return and holding the position for 12 trading sessions is a very good return on investment. And here's something else that you need to know, and this is very important to understand. When you buy a stock, your risk is obviously not the same as the margin on the stock. If you buy a stock for $50 per share and you buy 100 shares, you will need $5,000 margin or security deposit. But if you placed a stop loss of $1, your risk is going to be $100, not $5,000. In the three previous examples, the profit that you saw, the 18%, the 12%, the 25%, it was not based on risk. It was based on the actual margin that your broker will need to secure your position, which is typically much more than your risk on the trade. What I'm trying to say is this: your profit based on your risk would actually be much higher, and that's because we don't rely on the maximum risk to liquidate the spread. If you bought a stock at $50 per share, you wouldn't wait for it to go to zero to liquidate it. You would have a stop loss in place to liquidate the position in case it goes against you. Well, the examples of profit that I gave you did not take that into account. So when I made 25% return, I was using the worst case scenario, just like your broker would use. In reality, if the price of the spread would increase to a specific level beyond what we received as a net premium, we would end up liquidating the spread or buying it back at a loss. So in reality, we would never let the spread go to the worst case scenario, which is what the profit that you saw in the examples were based on. So your percentage of profit, when you compare it to the risk on the trade instead of the margin, would be substantially higher, since we would send you an alert to liquidate the spread and get out of a losing position long before it reaches the worst case scenario. So to give you a practical example of what I just explained, on the LinkedIn example that I demonstrated earlier, our profit based on the margin that the broker uses would be about 25%. But in reality, we brought in a little over $1 net credit on the spread. And if I recall correctly, our stop loss was around $2.50. And $1 is 40% of $2.50. So our profit based on the risk of the trade was actually roughly 40%, not 25%, for holding the position for only 4 trading sessions. So the numbers that I gave you earlier were actually lower than the actual profit that you would make if you calculated your profit based on risk, which is what you would do if you were trading directionally and using stops to liquidate the trade instead of initiating credit spreads and buying them back when they go against you. So far, and I expect these numbers going forward since we started the pilot program, which is what I always do before launching the program publicly for a few months. So this year, so far, we've had a total of 25 closed trades. And out of those trades, we've had a total of 2 losing trades, which puts our win rate above 90%. I believe it's at 92.5%. And from trading this way for roughly 2 decades, over time my success rate is close to about 85 to 87%. since I'm only looking for high probability opportunities, in addition to higher premium due to spikes in volatility levels. And I anticipate this type of performance to continue as we go forward, since I never initiate a credit spread or an iron condor spread that does not have at least 85% chance of expiring worthless, which is the key to all of this. This is an example of the ticket system that we use to keep track of the open and closed trades. The ticket system is designed based on each spread, since each credit spread is a separate trade and is always analyzed individually. So whenever you see a buy, you will always see a sell with it, since we never sell naked options. So each ticket corresponds to a credit spread. And if it's an iron condor spread, then the tickets will be related but separate, because it's easier to separate everything using one credit spread. The ticket has all the data that you need, including the opening price, the trade price, the option's expiration date, and the strike price, and also the reference price, which is the price that the underlying asset was at when we were filled on the trade, to give you a reference point. If a ticket has a related ticket, it'll also be posted on the ticket. In the closed trade section of the members area, you will see each open ticket and a closing ticket below it, unless the option expired worthless, and that would be noted as well. I find that using the ticket system helps avoid errors when traders are entering orders or trying to follow a trade, and we color code them for easy reference. They take a few minutes to get used to, but they're much easier to look at than a spreadsheet, especially the way we combine every ticket into a credit spread. This is a look inside the members area. It's very clean and functional, so you never have to wonder where to find what you're looking for. There's a getting started section which gets you up and running quickly. Then the next tab is the trade alert or the watch list tab, which would give you the latest recommendation. And once again, you would get an email with the same information once we release a trade idea. So you can either log in or you can check your email. Either way, you can check recommendations 24/7. Once the trade is filled, then it goes to the open position page. And then after it's closed, we move it to the closed position page. So you can always track the position and make sure that you're following all instructions accordingly. And you can see there's other tabs that give you the daily position updates for all currently open positions as well. And it's dated. And you can go back a few days to see past analysis if you missed it. And that's also available 24/7 by simply logging into your members area at any time. This is a letter from one of our members, Roy McKinney. And here's what Roy had to say about the Options Income Formula program. Prior to joining Options Income Formula, my options trading was hit or miss for many years. Your approach is reproducible, and after placing 7 trades, I made profit on 6, and my average profit on each trade was over 30% based on my risk per trade. The current market is not easy to trade, but I'm confident that I can apply your approach to options in bull and bear markets. I appreciate all that you do. Roy, I wanted to thank you for the nice words, and I'm looking forward to seeing your account grow over the next several months. When you enroll in the Options Income Formula, and I have to say I'm very excited about this program because we've been working really hard behind the scenes over the past few months. And I'd like to spend a bit of time telling you specifically what you get when you enroll in the program.
First, you get either 1 or 2 years of advisory alerts, whichever one you decide to partner with us on.
And I usually publish and email you 1 to 2 income opportunities per week. So if the market offers lots of opportunities, I'll give you 2. And if the market is calm and volatility is lower than usual, then we stick to 1 iron condor or credit spread, depending on the opportunity that the market gives that week. I'm not going to issue alerts on spreads just for the sake of issuing alerts. I want to make sure the probability is on our side.
And as I explained, I give you the entry range, the exit range, and the profit target range. I don't leave anything out. And once the position is open, I update you when we need to make any change or adjustment. So we walk you through from entry to exit. And you'll see these updates on our site, and you'll receive an email alert whenever something happens that requires your attention. These are follow-along programs. They do not require any analysis on your part. As part of your membership, you'll also get 24/7 access to your own members portal, and you can check it anytime that you like. So you'll get all updates emailed, and if you missed anything, you can just log into the members portal and get it there. As part of your membership, you'll also get access to me. So if you get stuck or if something is confusing, just email us and we'll respond to you very quickly, usually within a few hours, even on the weekends. Lastly, we received lots of requests from our members for videos, so I decided to do weekly Q&A videos, and these videos will cover a mix of education, answers to frequently asked questions, and important market updates and analysis, so that you can take something from these videos to learn more than just basic market analysis. And over time, these weekly videos are going to become a major resource. So that's also included in this membership. And I recognize that some of you are not credit spread or iron condor spread experts. So I'm also including this because we're launching a new options program. And I can assure you that going forward, this is not going to be part of the options income formula sales price. But I created a 24 module, 5.5 hour video course that covers options, credit spreads, and iron condor spreads from A to Z. Its regular price is going to be $797, but today, because we're launching Options Income Formula, we're including it at no extra cost. One of the benefits of this program, which is called Options Income Tactics, is the fact that I go through my complete selection criteria from A to Z based on different risk levels. In other words, I explain every step to how I select options based on different level of risk, and that's very valuable because that's the same approach that I utilize when I select credit spreads and iron condor spreads in the Options Income Formula advisory service. So by watching and studying these videos, you'll begin to understand my selection criteria, which is very important if you want to become an independent trader one day and not rely on me or anyone else. This is a 5.5 hour video course broken down into 24 modules, and it's called Options Income Tactics. So today,
When you sign up for either the 1 year or 2 years of Options Income Formula Advisory Program,
you'll also get the complete Options Income Tactics video course as part of today's offer. And once again, the regular price of this video course is going to be $797. So anyone who takes advantage of today's offer to the Options Income Formula is going to get an amazing deal. So the Options Income Formula gives you 6 advisory services in one. You get weekly options, monthly options, iron condors, credit spreads, stocks, and ETFs. So not only are you getting Options Income Tactics, which is $797 value,
but you're also getting $1,000 off the regular price of the 1 year membership. That's a savings of $1,797 by partnering up with us for 1 year. Should you decide to partner up with us for 2 years, you save $2,795 and pay only $1997,
which is an amazing value.
This is the only time you'll see Options Income Tactics video course bundled in with the Options Income Formula Advisory. And I want you to know that Todd and I really stand behind this service. So if over the next year you don't beat the returns of the S&P 500, we will gladly give you the second year for free. We want you to profit using these strategies, and we stand behind them 100%.
Keep in mind that space for Options Income Formula is limited, and there's lots of interest. So please enroll only if you're really serious about earning income trading options. Before I wrap up today, I'd like to read you another letter from a member of our pilot program that started in January. His name is Michael Potter, and here's what he had to say. I feel that Options Income Formula is helping me become a better trader. The strategies are simple, and I like how you identify the risk level every time you provide recommendations. I've used a few other advisory services before, but they didn't fit my trading style and my risk level. My account is up over $5,400 since I started, and I'm getting my money's worth. Thanks for sharing your professional knowledge, Michael Potter. And Michael, I'd like to thank you for the very nice words. Okay, we're opening up limited spots for this program. And if you're interested in learning more, you can follow the link on the screen. It'll take you to the page where you can sign up for the program right away. And we have some questions. So before I wrap it up, I'll answer them for you. And for those of you who already signed up, I'd like to congratulate you and welcome you to the program. The Options Income Formula is really 6 programs in one. So you get lots of value for your money. And I'm very excited about this program. And we have a question from Peter, who's asking if he can start with a small account. And I see about 15 questions that are all asking the same thing, so I'll expand on this. Yes, you can start with a small account. We have traders starting with a few $1,000s and building it up from there. These are high probability strategies, and we focus on risk more than profit, which is the key to all of this. But to narrow down what I mean, the examples that I showed you today all required less than $500 for margin, and substantially less than that for risk. So you don't need a large account to trade credit spreads nor iron condor spreads. You're not selling naked options, which requires massive margin. Your risk is only the difference between the two strike prices. And even then, you get to subtract from that your net premium. So if the spread is $5 and you receive $100, your margin is only $400. So if you have a $2,000 account, you can initiate several spreads at a time or multiple contracts on one spread. And if you're placing iron condor spreads, you can use that $400 to leverage or margin the entire iron condor spread, which is what I did in the 2 iron condor examples that I demonstrated today. Each one had a margin of less than $400, so you don't need a large account to trade these spreads. And in the Options Income Tactics course, I go over the best brokers in terms of software and commission and service so that you can get the lowest rates and the best margin for your dollar. And we have another question from David, who's asking if he can trade these spreads in an IRA account. And the answer is absolutely. They're all IRA friendly. And the reason for that, David, is because we're not selling naked options, which have unlimited risk of loss. Our risk is firmly limited and known or ascertained at the moment we enter the trade. We know our maximum profit, which is the net premium that we receive. We also know that the maximum risk is the difference between the two strike prices minus the net premium. And that's the worst case scenario if it's a credit spread. And if it's an iron condor spread, then the risk is even lower because the underlying stock or ETF cannot end up at expiration at 2 separate prices. It's not possible. As a matter of fact, they're actually more conservative than covered calls. And because I use technical analysis, market breadth, or momentum analysis, I'm able to squeeze a bit more profit out of these spreads, which adds up over time. Okay, Options Income Formula is selling very quickly, and this offer is only going to last today and possibly one more day. So I highly recommend you take advantage of this one-time low price. Before we close the door to this program, I like to keep my group size small so that I can offer personal attention and support, and we won't keep this offer open very long. So if you're interested in trading with me, follow the link on the screen and sign up for Options Income Formula today, and get Options Income Tactics on me when you sign up for the program today.
All right, I had a terrific time today, and I want to thank all of you that attended. I really hope you all learned a great deal from what I taught you today. I apologize for going so long, but I really wanted to give you everything that I had. If you have any further questions, please go ahead and type them in the box below. I'm going to go ahead and hand it back over to Todd.
All right, thanks, Roger. Absolutely fantastic presentation like always. All right, today was really long, so I'll keep this really short. And Roger pretty much answered all the questions that I've seen. So there's none right now, but if you've got any others, please just type them in below and we'll be sure to answer those for you. Okay. I now see we have only 9 spots available inside the Options Income Formula program. Geez, oh Pete, 16 slots have already been taken. All right, again, I want to congratulate those of you who signed up and took your first step in partnering with Roger and I. We're very excited about this program, of course, and it's really been doing extremely well lately. So please remember, we trade these exact signals as you'll be taking yourself, okay? We take these signals, okay? All right, I want to thank everyone for joining Roger and I today, and we hope you got a lot of useful and, most importantly, actionable trading information and tactics out of today's workshop training, okay? Again, to learn more about the Options Income Formula trading program, please just click on the link below, okay? And if you've got any further questions at all, please type them in below and we'll answer those for you before today is over. I promise you that, okay? Okay, then, again, this is Todd Mitchell wishing you lots and lots of success in your trading, and we truly hope to see you inside where you'll be able to partner with Roger and I. Again, thank you for taking your valuable time out of your busy schedules to join us today. We really, truly appreciate it. Bye for now.